All right, we're live here at Real Fridays. Every Friday, it's Real Friday at 12:30, roughly 12:30. Today's broadcast is going to be slightly delayed, but every Friday we talk about real things. It's an opportunity for mortgage insiders, both in tech and in mortgage lending and housing, to talk about what's happening both on the headlines as well as in the hallways of every mortgage company in the country. So I get a lot of calls. I'm sure you get them as well, Mike. I'm Rick Rock. I represent more on the independent mortgage banking sides of things, and Mike Kelleher is a well-known consultant, mortgage professional, and sort of technologist in the business. So how's it going, buddy?
It's going great. It's a Friday. I can see why you do it on Fridays. A lot of energy.
It's just, there's so much to talk about, especially during the course of the week, and it's just a good way of sort of ending the day and then going into the weekend, But no, it's fascinating. We have, rates have already improved slightly from the announcement yesterday. In fact, I don't even know if you have this. Do you have the Housing Wire? The Housing Wire, see if I can do the entire screen here. Do you have the Housing Wire beta? Are you on the Housing Wire beta program?
Yeah, I was invited to it.
It's a very cool dashboard that Housing Wire has put forward, and it highlights really anything you want. It's a series of widgets, and I'm giving them sort of feedback on it. But props to Diego and to how the Housing Wire team for putting this together. But as you can see, like, rates are kind of hovering right around 6%. I wouldn't be surprised if we went into the weekend at just below 6 and into the 5% range. I'll be really interested to see that. But yeah, I mean, it's a pretty fascinating announcement. Trump has a way of kind of shaking things up.
Yeah, and I think when rates move, it gives the local loan officer in the zip code an advantage over the servicer, because there is a lot of advice on what to do if you think rates are going down versus going up. So if you have insight and you have a gut instinct, I don't think that's where these retention softwares are not. They don't have gut instinct, right? They just have facts. Press a button and get your new payment. And I think this is going to really help this market, the people we talk to, our audiences. I'm excited. It's a good Friday. I think it's going to be a good January and a good year for good first half of the year. We'll wait till Mike Frantoni tells us at the IMB conference, because I think he was somewhat accurate last year.
Look, at February 2nd, I'm looking forward to going to the IMB conference. And you're going to be there. I think Jeremy and Brock are considering going. I'm not sure if they're going to attend or not.
I'm debating between full-fledged and fly in, fly out, but I think it's a very important conference. And if you're in the IMB space, there's a lot of conversation that happens. It's a good momentum setter going into the year, and it's a little less tech and a little bit more direction. And I think I like that, right off the bat.
No, it's interesting how you mentioned how technology can really help lenders stay on top of these mortgage market dynamics. I mean, we've already seen sort of a slight drop in the 10-year. And so I'll be curious to see exactly, what the response is as things sort of begin to normalize. I know that I posted yesterday on LinkedIn, our head of secondary at NFM had I think did a really good job internally circulating some direction to loan officers as to how they should, prepare realtors and borrowers as to how to understand these recent announcements by the administration. And I think that sorry, I'm getting a call here that I had to decline. But as of this morning, the MBS has rallied, modestly as of market closing and the market opening this morning, and the 10-year Treasury has hovered around 4% or so. So it's not a ton of movement, but I think we're cautiously optimistic as far as how we can, coach our borrowers as to whether or not to, prepare to pull the trigger on a property that they're watching, or to kind of monitor what that monthly payment's going to look like. So when rates go down to just enough, it can very much fit in the sweet spot of someone's budget. But that's where the technology comes into play. We have that chat. We have an NFM chat GPT that really sort of monitors that and is a lot more proactive, for the loan officers. And I know other organizations do as well, but I think it'll be pretty interesting.
Yeah, I think right now is a very good microcosm for where the industry's been, where it's going. You take a day like today, you take the announcements that President Trump has been saying on Twitter or Truth Social recently. I've been posting about it like right now this week, and there's about 7 or 8 days left where your real estate agent partners, their number one goal in the new year is to be on more social media, to podcast more, whatever that is. Like, this is the one time that if you can give them some help there, they are going to lean into it. And you have the topics now, and rates go down like today. And so you have to ask yourself, I believe, as a loan officer, do I act today the same way I act every day, which is go through my LOS and look at opportunities with this new rate piece? Or do I play a little bit of the longer game, take the information from the NFM secondary manager, take the hot topics, reach out to a realtor and say, hey, let's make a quick, like you and I right now, let's do a quick 30-minute talk on this. Let's learn by doing it how to start. Like you and both and I think 2 years ago, maybe 3, didn't know how to use StreamYard. Now it's our go-to, right? You learn through trial and error. And so I think there's 2 options right now. You have the loan officers right now that are sitting there and do what I did back when I originated 15 years ago. You go through your pipelines and you see if anybody matches up with these great new rates today, see if you can pick off 1 or 2. Or do you find some time today to do what you would have done if rates didn't go down, or should have done in December as part of your goals? But go out there and find that real estate agent that said they were going to do more social media. It's already day 9 of the new year. They've only got 1 new post up, and say, hey, I have some ideas on how we could do a post together. Let's talk about the rates trending. Let's talk about, the fact that Blackstone can't buy big properties and what that means for our local area and the opportunity to purchase. And let's get some views. Let's get some clicks. Let's get some action. Because ultimately that gets you the relationship, so that when this purchase market really is running later on, you're more in the hip. You might be giving up that 1 extra opportunity to pitch a deal later tonight, but that doesn't mean you didn't necessarily get that deal. So do you want to start building a local zip code presence and use this momentum while you have it in your head, like this is a good thing? Or do you want to give that up today to try and chip away? And really, that's probably what you did last quarter, last year, last decade. So I think it's because of the timing of the year, I would just be careful not to lose focus of this is a really good time to reach out to real estate agents and help them with their goals, which is typically social media.
Yeah. It's interesting. What do you think the status of just vendors as a whole, in like the status of mortgage tech? When Jeremy's talked about this quite a bit, where, in down cycles, there tends to be a lot more of an urgent need to innovate, because you're trying to sort of innovate your way through into new production opportunities, or to lower cost and to sort of streamline, your process. But then when things are really busy, you kind of stick with what you have. And you're not quite as incentivized to lower cost, because in essence, what's lowering cost is volume, right? On a cost pre-close loan basis, as opposed to actually pulling an efficient strategy together. So what do you think the vendor community's response is to Trump's announcement of buying $200 billion in mortgage-backed securities to try to push mortgage rates lower? Pretty favorable, or do you think they're as cautious around it, trying to figure out, well, shoot, now how am I going to get the attention of potential customers when it's already a pretty difficult thing to do. But now that they're going to be potentially even more busy, it'll be that much more difficult.
I think it's a tail that wags the dog. The controversial line would be, my observation now is, it seems to me 70% of vendor purchases by lenders are to give the perception of we're growing or momentum. We have something new, to give the culture at the company that we're not standing still. We're not going backwards. We have money. Are they picking the best 70% of the time, or what they exactly need? No. The other 30% will pop up here and there, and they really are great technologies. I'm wearing Sapiens Decision. I believe that is a great one for companies trying to roll out DSCR products and actually taking market share seriously on DSCR. But I see a lot of lenders, I guess I'll get to your question, but why don't we just talk about this for a second? I see a lot of lenders now hiring somebody that's really good at AI. They're usually young. They're usually a friend of the family or some neighbor or referral. They're getting a good salary from the lender, and they're taking two approaches. One is trying to rebuild existing mortgage tech out there and have their whiz kid do it, and he or she may be able to do it. I mean, the technology is getting pretty insane on the Claude side. And then there's others that hopefully realize you probably should have one of these. You could use Claude to create UI, which is user interface, dashboards, websites, and build on top of the tech and sort of use it as spackle to actually get customers to use the parts of the reason you bought the tech. And so I think there's a lot of headwinds for vendors. I think being busy is always a problem, but being busy and actually believing it's going to be a great year is what the vendor community has needed for a couple of years now. So I think they're all going to invest more in, if this keeps up, because it's also important, Rick, you know this is like in the news now. So it's not just like rates are going down. The public perception all of a sudden is that rates should go down. They don't know the metrics of how it actually goes down. Their LinkedIn feed isn't talking about how 200 billion of MBS is only a 1 month supply. They now have this perception it's going down. More phones are going to ring, and that is going to open up the pocketbooks for vendors or lenders to pick vendors. And I think vendors are hoping that all the relationships they built over the past 3 years are why a lender now will move forward with them. You can tell me on your side. I don't know if a lender says, well, a lot's changed in 3 years. Should I go look at new tech, or do I owe this person that I met 3 times the last 3 conferences this opportunity now because we have the budget for it? And that's probably always been a question.
You know, it is tough being a vendor. There's no question about it. I mean, I remember those days. I mean, I would say that always trying to get in front of lender partners is difficult, but it's such a relationship driven game. You know, as you know, oftentimes vendors not with the best technology are kind of cut in front of the line based on relationships that they have with various executives, which is, I think, why Adopt the Brand is is a tremendous value to startups and in mid-stage companies, because they're trying to get traction and they're trying to invest the best ways of getting traction to be able to get in front of key decision makers and leaders to build those relationships. It's hard. It's hard to get in front of people, especially when they're busy. I can't tell you. That's why it's such a repetitive cycle. You got to go to the conferences. You got to do the follow-ups. You got to stop in when you're in town. Got to grab coffee. It's all about sort of building that relationship just to get the airtime to be able to continue to give them updates as to the evolution of your tech and the continued value proposition of the tech. It is interesting the number of AI companies that are emerging, and the number of it seems like it balances between a few years ago it was a number of startups or LOS companies, and then it was POS companies, and then it was And then it kind of went to title and title tech companies. You know what I mean? And then it went to lead gen organizations. It seems like depends on obviously the market, different pockets of vendors emerge. And now it's, AI everything, AI in sales, AI in operations, AI toolkits. It's kind of across the board.
Yeah, I'll give the audience a great example I heard yesterday on an executive call. So obviously a big pain point for people is how to sort their e-folder. A great example is in the e-folder, you'll have invoices, and those could be invoices for you as a mortgage company or the title invoice. It's difficult for OCR providers to provide that at a level that they should, because it's so disorganized and you're paying for them to look for the document before they even read it. But a lot of the leading OCR providers that we all know that you get relationships with built proprietary OCR 3 or 4 years ago. And the new AI and the fact that a lot of them now use AWS and Google is sort of in this game behind the scenes. It's all open source. And so Google has read millions of pay stubs. So you have this older company that says, we've read 500,000, 900,000, whatever pay stubs. They should be the best, right? The problem for them is their proprietary valuation is based on this OCR engine that they built on old tech. So if they went to the open source model, even though it's faster, better, they'd lose that valuation. So I think that's an example of AI has allowed companies, and you'll see it in the OCR space, where you can build it at $100,000 and $200,000 in 4 months, what took them years and years to do. So yeah, AI is coming. I think it's for the lenders. It's at least working with an incumbent. It's kind of seeing like how did the incumbent's clients roll it out, because the larger problem is usually in poor rollout or poor adoption. That's the advantage the older companies have, not their tech anymore. The AI, you can build on new open source so much faster, and it looks so much better. Like Flare, right? That'd be an example.
Yeah, well, it was shocking when I was, because I'm advising Flare and trying to just better understand, like, okay, great, their value proposition is pretty amazing. So what's the timeline? What's the cost and the timeline to implement? And they're doing it in 45 days, 45 to 60 days, at a pretty reasonable cost. So it's pretty fascinating how accelerated the adoption lifecycle is, especially for AI and the implementation for it, because it's so sticky. Our engagement internally at NFM with our GPT tools is off the charts. So it's not like the old days where we'd buy some legacy software, we put it on a server, we buy on a per seat basis, and then we'd have to sort of push it out to the field and then somehow force the field to use. It's just the software is just becoming so intuitive, where loan officers are able and useful. It's intuitive and useful immediately, and when they feel that impact right out of the gate immediately, there's not a ton of setup. It's immediate engagement. It just drives. Maybe it's a dopamine thing. Maybe it's just kind of our how we've been Instagrammed. Where you just start scrolling and it just becomes so automatic. And I think AI to some degree enables applications to be automatic, engagement with consumers be automatic, engagement, looking up products and guidelines, automatic. I think that there's something to be said for that. Not just something to be said, but I think there's a lot of truth to that.
And if you really want to know, like, if you have something that is going to set the world on fire in mortgage, it's if I show it to a group that's doing $40 million a month in production, will they come over because this tech exists? There's a couple of those right now. There's been a couple of those over the last 15 years. If you don't accomplish that, it's very difficult to be the software to compare yourselves to some of the software that exited right around COVID. Like that's not coming again unless you can figure out how you can give a lender something that they show a branch. Now the branch needs it and they come over for it. I think that would be, if I was brought in to say, what would be the best mortgage tech you could possibly think of? It's starting there and working your way back. That's the only way you would get what happened in the old days, which is you get 20 people to sign up at a time or 40 people are lined up. I'm experiencing it with one technology right now. But it's hard to find 2 or 3 or 4 or 5 that fit that mold. But if it was easy, everybody would be doing it. Right.
Yeah. Who I booked Diego from Housing Wire to be on Real Fridays next Friday, but who's coming up on your podcast? I saw someone that you just announced that you're going to have here pretty soon.
Yeah. So one, we had Ed Powell on the last show. He runs Consumer Direct. I would love to have a couple more like him on there. Really breaks down for all of us mortgage nerds how the little things go into making it a successful operation or not, and all the little things we can understand as mortgage operators. So he was great, and he really talked candidly about what works. Even like calling leads, knowing that at 8 a.m. is when the first tape comes out on the East Coast, and then 9 a.m. it's the Central. Little cool things like that get me excited. We have Jim Carroll coming back. He was a father-son mortgage company, Carroll Mortgage, back in the day. He's helped stand up a couple banks. By standing up a couple, he's actually helped stand up a couple LOSs that needed an experimental partner to start with. And actually one didn't go well. Like it took 18 extra months, and eventually I think he left the bank before they could even get it.
Was that a separate more loan origination system, or
it was one you would know the name of?
What was the name of the loan origination system?
I don't want to say it just in case there's a chance I'm wrong on it, but it's one of like the 4 names that you would know. It's a little bit newer.
Do you remember Blueberry back in the day? That was one that
Easy Mortgage Apps integrated with Blueberry.
What's that?
Yeah, Easy Mortgage Apps integrated with Blueberry for Cherry Creek.
Yeah,
we
that's
spent
right.
a lot of time with Mike Hole.
Yeah, well, yeah, that had some promise to it. What's his name over at Loan Depot now? He was the sort of the one of the founders of Blueberry, right?
What was he? All I know is Will Armstrong was one of the he was just really into tech as a mortgage company. But it's a great example. Like everybody raves about it, but where is it now? How much time was put into it and how much value did Cherry Creek? That wasn't even part of the sale to Guild. So is building your own in-house LOS really worth it? Not just the money, but all the headaches and how hard it is for vendors to integrate. That's a good example. That I believe is now over at Loramac, but that did not sell as part of the Guild transaction. If it was valuable, it would have, I guess, is my point.
Yeah,
right?
I think it when I was consulting at American Financial Network, very, very, very innovative company. John's a friend and a really smart guy. But you can really spend so much money and so many cycles on new tech, on new CRM, on new features. And it's great in the moment until you realize you got to support it. You got to evolve it. You got to really be committed to the longer term vision of this product if you're going to build it. It's not a whimsical, like I have extra cash, I want to build something, because it's such a short term, just limited kind of perspective. And I don't necessarily blame, AFN for trying or any of these organizations for trying, because sometimes it helps. It adds a lot of organizational value. You get someone like Matt Van Fossen, who's got a lot of traction on his point of sale. And there's no question that if theoretically speaking, I mean, he's not going to sell his company, but I'm saying theoretically speaking, if he did sell his company, he could do a Bill Dallas kind of thing where you sell your mortgage company combined with Cloud Verga, and you get this sort of amplified, valuation on the organization. So if you're really ambitious and you want that sort of tech valuation to your mortgage company, it's not a bad strategy.
But I'll say, like, people starting, because people starting should be watching this show first and foremost. Matt worked a long time to put this all together. He had LOS Fusion before the point of sale. My point is, I even heard it the other day, and one of the biggest parts that hit me financially was when I first started with the mobile app. Nobody would do any business with me until I took my license away. So I couldn't originate. I had to bootstrap and make zero money. And I thought that was all done with. And somebody told me the other day, a tech person, they had to give up their involvement in a mortgage company because nobody wanted to give them data as a mortgage company. So Matt is one of the few rare ones that has been able to sell outside of his company and build enough trust. But if you're just starting and you also originate or have a partnership with, that still exists. I've come to find out over the last couple months. There are a lot of lenders that are afraid to give you full access to their LOS.
Yeah.
If you have any,
look,
I think the person said, "Look, we're putting it in AWS." That's what he said back to him. This guy was like, he wrote stuff for Wells Fargo, US Bank. He couldn't believe this was happening, and he's like, "It's in AWS. That's where all the." I have to follow the same laws that they do. Everybody's Encompass data is in AWS, but it just, and then that thing, he built this whole piece, and then the lender didn't want to launch it unless it was pay per play. They wouldn't pay any money up front. And so you still got to be careful of those speed bumps as a young entrepreneur in this space. Just because you went through a mortgage, you were a little bit frustrated. You should probably go to Dr. Rick Rock University before you just think that's enough to get. Plus, it's a small market, even though it's big. Like, we're all going to be down at the IMB. It's not like you could just take off from a total addressable market standpoint. You need to win within the niches. So, that'd be my advice on the way out here as we come to the end of time.
Yeah, no, I'm with you. I know you got to go. You have a 12:30, and
I'll leave though, so you can keep going. Maybe you can do a monologue.
Well, no, look, I appreciate you filling in, and I'm looking forward to continuing our partnership and our late night chat. So
I'll be on anytime you can't get a guest.
Oh yeah, that sounds great. I appreciate you.
Thanks, Rick.
Well, good. Well, we'll just call it a wrap. But we're here for Real Fridays. But it was a good dialogue. Good luck at your 12:30 meeting, and I look forward to seeing you in a couple of weeks at the IMB. Okay.
Okay. Thanks.
Take care.